Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Alright, I've been warning about this Q2 from back last year. It seemed obvious and inevitable that ramping up these two new factories, and one of them being the largest in the world, well, there's going to be some extra costs involved. The overheads of the factories are pretty much the same, irrelevant of the number of vehicles that are being produced. Therefore, during ramping, the costs are going to be higher per vehicle than compared to when they hit volume production. The question might be, will Berlin and Texas actually run at a loss? In other words, will EPS be higher than the previous quarter or lower? Now let's go back to look at the previous ramp-ups from Tesla when they introduced the Model 3 into Fremont, the Model 3 in Shanghai, then the Model Y in Fremont and the Model Y in Shanghai. Let's take a look at what effect it had on margins and cost of goods sold, and see if we can try and gather some sort of information. From there, we'll try and take a stab in the dark, and I think it's a bit of guesswork as to where we might see the margins for Q2. Unlike the previous ramps, it's been down to the actual rate at which Tesla can increase these vehicle production lines, but it sounds like they're getting very experienced at that now, and these two new factories are much simpler, so it shouldn't take as long to ramp. It's really more about the amount of cells Tesla have available to them. It sounds like cells will quickly become the limiting factor again. And to be honest, Elon was kind of coy about the 4680 production, sounding like it may not be the levels we want to see until early next year, and that Texas also has a 2170 backup in place too. Like I say, the next level of this company is still all about 4680 production ramping. As soon as I get confirmation on those lines going well, I'm leveraging my position again. I actually sold one option when the market opened the other day after earnings, when the stock was above 1080. I think this is what it's going to take to get the stock price back up. There may be a boost from the split, but in the meantime, there might be plenty of reasons for the stock price to be down for a large part of the rest of the year. In fact, we're hearing a disappointing 30,000 vehicles just for the year. You see, I told you that factory being delayed wouldn't make much difference, as it didn't mean batteries will be produced any faster. It sounds like numbers will be low. I think this is due to the fact they're depending on just 2170 sales. Sure, they are only selling their most profitable model, the performance version, but we still might not see decent margins. In addition to that, it would appear that we've lost a whole month of production time in Giga Shanghai for Q2. Shanghai is still Tesla's biggest performing factory. This will result in fewer vehicles potentially for the quarter. That's a lot of catching up to do. It may also take some time to ramp back up, effectively losing more production. However, Tesla are supposedly chip constrained, and this would have not affected chip production or supply, so perhaps Tesla can just ramp up those production lines that much faster and make up for the downtime. Unfortunately, it's also likely the new CATL factory, supplying a lot of the batteries, would have also been closed during this lockdown. Anyway, it might be interesting to see what kind of numbers Tesla can actually squeeze out for the other 2 months of this quarter in China. We may end up getting a better indication of what this factory can do when it really wants to. And this was somewhat indicated on the earnings call, that we'll see some record weeks come out of China this quarter, which will be interesting to see. Alright, so let's look at the history Tesla had when they released the Model Y in 2017. In Q3 2017, Tesla delivered 220 Model 3s. In Q4, it was up to 1,550. So Q4 was likely the first full quarter we saw Tesla running the Model 3 line. Now, bear in mind, Tesla were already running the Fremont factory and associated costs. This was just an additional line. It was also plagued with issues, as Tesla went through the process of learning how to reach volume production, aka production hell. I've compared the Q2, Q3 and Q4 in a table, with the revenue, costs and margins before Model 3 and after. We can clearly see it took a huge hit. Tesla had actually broken even with the S and X production, believe it or not. However, with the Model 3, they were quickly back to losses. The Model 3 was only accounting for about 5% of vehicle sales at this stage too. We went from 28% gross margin to 18%. That is a huge difference. Anyway, Tesla pulled some magic and set it on to path to profitability, but before it reached profitability, Tesla opened a new factory. And the next launch was the Model 3 factory in Shanghai. Now that came online in Q4 2019, but it didn't seem to affect margins significantly. However, this could also be due to Fremont ramping up simultaneously. So although costs were increasing in China, the profits from Fremont were potentially offsetting these costs. However, we saw an increase in margin by almost 2.5% from Q2 to Q3 in 2020. This is most likely attributable to the difference it made in China when it was starting to ramp up, and the production was hitting close to 15,000 Model 3s a month. Also, bear in mind the Shanghai factory is relatively smaller and would be more efficient to run, and Tesla had learned a lot from their Model 3 set up in Fremont, so Tesla are getting better at this. Tesla also added the Model Y line in Fremont too at a similar time, which was also impacting margins. Then, of course, Tesla's Model Y factory in Shanghai, the latest factory to come online before the two new ones. Well, as Tesla have ramped up that Model Y facility in Shanghai, we've also seen the margins improve too. I don't believe there was much reason for Fremont to improve these margins, so I think it was all being impacted by China and the fact that they were not at volume production. We're talking a difference of 4% in margins, just over 12 months. Like I said though, the problem with Berlin is it looks like the production numbers will remain low for some time, perhaps only 1,000 units a week. This is really going to cost. That factory will not be as cheap as the factories in China to keep on. Yes, we have a lot more buffer these days, given the level of production we've reached and from 2 other factories. But by the same token, look at the size of these new factories. It's very early to say, but I think margins could be possibly in the 20s, perhaps somewhere around 22 to 24%. Remember, we've also lost probably a quarter of production of China for this quarter as well. I think this will result in a lower EPS than Q1. In this scenario, I'm going to guess that headlines that say Tesla's earnings plummet are going to get some good clicks, which will only further exacerbate the situation. Then add into that some short sellers and market manipulation, there is a potential for the stock to take a real hit. All I can say is it will be dependent on the 4680 production, in case you haven't got tired of me saying that yet. But Tesla are not even selling these 4680 vehicles to the public yet. It doesn't sound like the rest of the year will get any better for Germany, and Texas may be slow to ramp up with 4680s, whilst costing a fortune just to keep the lights on. Q3 could be almost as bad, but I'm thinking there is even a potential for a bad Q4 too. There'll be a sharp upturn as soon as they get the 4680 lines ramping in both locations, and that is when Tesla has reached the next level, and the stock price will be due for its next breakout, in my opinion. It really would be good to get some idea of Texas. We just need to hang in there until these factories are ramped up, then things will be looking good. In case you are wondering how I might trade through this, well, it's tough. There could be macroeconomic issues to deal with on top. There's even a high possibility of going into a recession. I think there is a chance of some bargains for the stock price. Of course, we never know what Tesla could do that will break out the stock either. I'm probably going to reduce some of my leverage until I get 4680 confirmation. There are quite a few wildcards around this year. Of course, there is also the split coming, which might put some momentum back into the stock price too. I mean, I say this without a crystal ball like usual, but I get the feeling there could be some good buying opportunities for the stock this year. We just need to work out what a good price will be. It could mean likely a fair amount of volatility, but nothing unusual about that. At a guess, around $800 to $1,200, at least up until Q3. By Q4, I think we should have seen some decent progress of 4680s. I mean, Elon was talking about 100 gigawatt hours a year from there recently. That's about 1.5 million Model Ys a year. If Tesla are at 100 gigawatt hours a year run rate for 4680s, then you'd think the stock has got to adjust to around $3,000 within soon enough time. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.